and, thinking like, oh, Bitcoin's coming back just to be let down again, right? So if that happens, you can make a strong argument that the overall market is also probably going lower and bottoming in the fourth quarter of this year, right? So just something to kind of keep in mind there. Now, I got to give everybody a huge warning. Do not, I repeat, do not let 2026 buying opportunities pass you right by like people did in April of last year with incredible discounts on stocks all over the place, like people did in 2022. 2022 was a generational buying opportunity in countless tech stocks. Tesla fell to $100. Palantir was trading at $6. Meta was trading at $88. Netflix was trading at a fraction of the price it's trading at right now. Shopify was trading at $25. It was insane. It was a generational buying opportunity for countless tech stocks, right? Like so many of these companies, it won't be until their business models are irrelevant anymore and they lose their total management teams that are there that they'll ever even see those prices again, okay? Generational buying opportunity. Passed so many people by. People are getting devastated in the market. They say, screw this, stocks are a scam. They left the market and they missed generational buying opportunities in so many tech stocks out there, right? 2020, huge buying opportunity, a scary one because obviously they're talking about the economy could be closed for, years, but generational buying opportunity in regards to the market itself. 2018 was it was a beautiful buying opportunity at the end of 2018. 2009, I wish I had a lot more money. Back in 2009. The problem was I was just getting started in the market. I got started in the market at the very end of 08, 09. Dude, you know how much I was making back then? I was making like $8.25 an hour. Oh, if only I had a lot more money. If only I had a lot more money back then, right? But of course, I'd be a lot older gentleman than 36 years old if I had a lot more money back then, right? But the moral of the story is do not let this opportunity pass you. The discounts you're getting now, and if we get even bigger discounts, don't let it pass you, because this is what happens time and time again. People say this time's different, the market's never coming back, blah, 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 right? And they let all these stocks go, pass them right by, all to a year later, a few years later, look back and be like, how did I not buy that stock down 70%, and that stock down 60%, and that stock down 80%, and that happens again and again and again. Never fails, right? Don't let it pass you by. Alrighty, next up here, AMD. What's going on here with AMD? My thoughts on this crash, what my plans are with the stock. Then we're going to Google McDougal, Elf on a Shelf, and my entire buys watch list, okay? Listen, AMD just got some great news. Do you know what the news was? Google McDougal is going to absolutely spend like a drunken sailor. They're talking about doubling their CapEx. I mean, just ridiculous numbers in regards to Google. They're so far ahead of what anybody was anticipating them spending for CapEx. It's a holy smokers, this ain't no joke situation, right? They're talking, and keep in mind, this number, they were talking about like $180 billion of spend in 2026 was, I think Wall Street was at like 120, which was a huge number. They're talking about 180, can be flipping my flapjacks, right? This comes right after last week, Meta said they're going to spend between 115 to 135 billion in 2026, right? Which was an insane number to hear. And now Google just said, oh, that's it? 125 midpoint? We're going to spend like 180 billion, okay? That's insane. Now, guess what? One of my other companies, Amazon, company I'm up 143,000 on. This company, big investment for me. It matters tomorrow. $362,000 investment of mine. Guess what? Amazon's going to say they're going to spend crazy on CapEx as well. So you got just company after company just putting up crazy CapEx numbers. And guess what? That's very bullish for AMD, right? I posted this inside the private stock group. I said, CapEx $180 billion, billion, almost fell off the couch. It was true. Like, oh my gosh, when I saw that number, I was like, what? 180 billion, right? But the bottom line is this is very bullish for NVIDIA, very bullish for AMD, and very bullish for Broadcom, right? So we have a scenario here where AMD reports great numbers. They beat analyst expectations. They beat in terms of the guidance. Lisa Su said all the positive things you could have possibly said when she went on CNBC here today. The conference call was great. But guess what? The stock still went down. It's insane, right? Absolutely insane. Now, keep this in mind. This is very important, okay? Given Google's absolutely ridiculous CapEx spend for 26 that's expected, Meta, Amazon's going to put a crazy number up as well, right? These companies honestly have no choice but to moderate spending massively in 2027. No choice. The spending is so out of control, the increase is so out of control, they're going to have no choice but to moderate, okay? And so, like, it's just starting to take so much of their revenue and profits now at this point in time. It's just like everything's just basically going to CapEx, right? So they're going to have no choice but to moderate the spend. When I say moderate the spend, that does not mean necessarily pull it down. That doesn't mean like Meta spends 130 billion this year and they all of a sudden say in 2027 we're only going to spend 80 billion or something like that. That could happen, but that's a lower probability. It's just more like if they do have any increase, it's a very small increase then at that point in time, right? Now, if the market grinds down the next 9 months, that's going to give even more like the market will basically force Google, Meta, all these companies to moderate spending in a pretty substantial way, right? Now, the reason that's important is that's actually great news for AMD. And the reason being is AMD is the value play next to NVIDIA, right? And I told you guys this, I've explained this since last year regarding AMD and NVIDIA, right? I've explained this time and time again. It's very important everybody understands this. Listen, NVIDIA is AMD's best friend. AMD is NVIDIA's worst nightmare, okay? There's a big difference here, okay? And so you look at like the OpenAI and AMD deal, right? This is fascinating because basically AMD's margins are going up right now and they're going to continue to go up for the next several years. And the reason being is NVIDIA went so crazy with the pricing on their chips that AMD is able to command margins that they've never seen basically ever, right? Meanwhile, AMD is going to force NVIDIA to likely bring their margins down because if AMD is undercutting price, right, and starts stealing away a lot of market share, NVIDIA then has no choice but to do what? Cut prices. Here's the issue. If NVIDIA cuts prices, right, their margins are going down to Chinatown. Additionally, this is even a bigger issue. That would then be NVIDIA admitting that AMD is right there with them. And NVIDIA's had this kind of like thought over the last several years of like, there's no competition for NVIDIA. It's them by themselves. If suddenly you have to start cutting price because AMD's putting the pressure on, your margins start going down, then everybody realizes you're nothing special. You're more commodity, right? That's a hard thing to admit. That's a hard thing to admit because that could hit your stock price hard. That could hit the morale of your company hard. Ooh boy, your margins start going down and people start looking at you as more just commodity play. That's tough, right? That's very, very tough. Now, the other issue is NVIDIA is it's supposed to invest in OpenAI. Now they're trying to like pull back from that whole thing. And they're like, well, they invited us to invest, but that doesn't mean we're going to for sure. We're considering it, right? But NVIDIA is supposed to supposedly invest in OpenAI. Meanwhile, OpenAI is investing in AMD, right? They're supposed to buy a massive quantity of AMD chips over the next several years. And if OpenAI comes through with all their purchases, they could acquire up to 10% of AMD. That cannot make you feel good if you're NVIDIA, right? Like, oh, we're going to potentially invest into you so you can buy a bunch of AMD chips and then get a bunch of ownership of AMD. I don't think NVIDIA would be, it would be that happy about it, right? So this is a whole fascinating situation in regards to this, right? Now, additionally, I think this really matters significantly because this kind of came out on the DL, right? But there's been recent reports that suggest tension between OpenAI and NVIDIA, primarily driven by dissatisfaction over the performance of some of NVIDIA's hardware for specific tasks. People assume, oh, NVIDIA got these super high-end chips, so they're just great for everything, right? Not necessarily. If you look at some custom chips, they could be much better for certain tasks than actually what NVIDIA does, right? Performance concerns. Sources indicate that OpenAI is not satisfied with the speed of certain NVIDIA chips regarding AI inference. The process of answering user queries, particularly for software development tasks, okay? Basically not giving, I've also heard like something about like not giving answers like quick enough, right? And guess what Lisa Su's been talking about the last year, if not last 2 years? She's been talking about how AMD is very well positioned for inference, right? Whereas NVIDIA really got out there in terms of training these models in a huge way and just totally won that market, right? But she's been talking about inference is going to be orders of magnitude bigger than training was, and that AMD is very well positioned for inference, right? It's all lining up, baby. It's all lining up. So as far as me and what I'm doing with my AMD stock, listen, I'm holding every share as tight as I possibly can, right? I'm a very happy shareholder. I spoke about AMD in this video here from 22 hours ago. 104,000 people have gotten to see it so far. It's called AMD Own It. In that video, I also gave my projections for AMD stock over the next several years, okay? So if you're at all interested in AMD, make sure you check out that video when this one's over here today, okay? Alrighty, next up here, Google, McDougal, my plan with that stock, then we'll get into Elf on a Shelf, and then we'll get into my possible buys watch list, every single stock, okay? Google, listen, they all wanted the stock to go up. When I say they, I'm talking Wall Streeters. They bought this stock relentlessly the last 6 months. They wanted this one to print so bad, so bad. This was the one big tech that they really wanted to go up. The Mag 7, they really wanted to go up. But the insane CapEx Google just came in with, it screwed up everything, right? I mean, the number was just so ridiculous that it's just like, they tried so hard to get the stock up in aftermarket, but I mean, that CapEx number is just so huge, it scares a lot of people away, okay? No, let's be quite honest, this is a grade A income statement. It's a banger from Google McDougal, as you would expect. Revenue, 18% growth year over year, almost $114 billion of revenue from $96 billion. Cost of revenues only went up 13% versus 18% revenues. Winner, winner, chicken dinner. The issue, look at R&D. R&D is rising rapidly for the company. 42% growth. Keep in mind, that's coming off of a low base. That base is starting to get big. So imagine 42% again next year on a now $18.5 billion number. All of a sudden, R&D starts to hit you hard, right? When you're having these sorts of increases and the base keeps getting bigger. It's fine when the base is really small, but as that base gets bigger and bigger and bigger, ooh boy. And we'll talk about why that's going so insane in just a moment. Sales and marketing was only up 12%. That's not bad. G&A, general administrative, that one was a trouble spot. That was up 21%. So total costs and expenses, this was kind of a trouble spot. It was up 19% year over year. So income from operations was up very nicely year over year, right, to $35.9 billion from $30.9 billion. But that was up 16%. That's the only reason I didn't give them an A plus here, and I gave them a grade A, because income from operations rose at a slower clip than revenue rose, okay? Now, other income, that was up 150% year over year. Income before income taxes up 21%. Net income up 30%. Diluted EPS up 31%. So banger earnings for Google, as you would expect. That's the reason it's like a $4 trillion market cap or whatever it is. 4 trillion is a big number, right? Balance sheet's a beast on this company. Look at cash and cash equivalents, $30 billion plus versus $23 billion the same quarter last year. Marketable securities, $96 billion versus $72 billion. Total cash, marketable securities, and cash equivalents, $126, almost $127 billion versus $95 billion, right? Long-term debt has peaked up a bit, so that is something to keep in mind. Long-term debt went from $10.8 billion to $46.5. This is an issue here. You look at a company like Google, okay? They're talking about spending $180 billion on CapEx in 26, okay? And by the way, shareholder equity up to $415. So the balance sheet's still amazing at Google, okay? Listen, for as long as I can remember, basically since I've been in the market back in like 08, 09, Google's always had one of the best balance sheets in the world. Here's the issue. They want to spend $180 billion on CapEx this year, right? Probably another crazy number next year. Some of that you can fund out of profits, right? But you might start taking on a lot of debt. Imagine Google 3 years from now with a huge debt load on this company. Imagine them with hundreds of billions of dollars of long-term debt. Then we can't call Google a great balance sheet anymore. And that's the issue with these companies spending so insane and taking these business models from being asset light to asset heavy. They just went from $10 billion of long-term debt to now, $40 billion plus? And now they're going to really start spending like a drunken sailor? You could be looking at Google a few years from now with hundreds of billions of dollars of long-term debt. Now, is that a death knell for the company? No, because they still make crazy profits. Their revenue's great. It's not like, you're going to zero because they've got hundreds of billions of dollars of debt. They can handle it, but it makes you start to look at the company different. You start looking at the company as like, they're one of those companies again. One of those huge debt-laden, massive debt companies, right? That's where things could go with Google. And I'm going to be honest, that's where things are probably going with Google. You're going to look at this company a few years from now and you're going to look at that balance sheet and you'll see hundreds of billions of dollars of long-term debt. And this was always a company that the debt was never even like a subject. It was basically like they had non-existent debt, right? Or you even look at this company, at this time last year, $10 billion, literally nothing. All of a sudden this company has $300 billion of long-term debt. That's a different story, right? I don't know if I really want to hold a third company that is just absolutely out of control with their spending, right? And so I might take my profits out of Google and invest that elsewhere. I might go ahead and do it, right? Now, the other issue with Google is if you look at my base case, this is my old base case. I've got to update this. I had them doing 14% net income growth on average per year, 2026 to 2029. Based upon how insane that CapEx is going, I don't think they're going to do it. I don't think they're going to do it. Even with, in my base case, I have them growing revenues 12% on average per year, 26 to 29. I'll be honest with you guys, I don't think they're going to be able to do it. So that net income is likely not going up as high as I think it's going. I had them doing net income of $220 billion in 2029. With how hard that CapEx is going to hit depreciation, which is going to hit that R&D line item, I don't think they're going to do it, man.
But blockbuster holiday season, the companies would start laying off, and it's happening. Challenger Gray and Christmas just reported that U.S.-based employers announced 108,435 job cuts in January. That's an increase of 118% from the 49,795 cuts announced in the same month last year. It's up 205% from the 35,553 job cuts announced back in December. And I want you to understand, this is very unusual because when the economy is growing, many of those part-time, holiday, seasonal jobs, they turn into full-time jobs. What we're seeing right now is the exact opposite. January's total is the highest for the month since 2009, back when 241,749 job cuts were announced. In fact, it's the highest monthly total since October of 2025, when over 153,000 cuts were recorded. Now, this isn't just a sign that employers are less than optimistic, because that's what the media wants you to believe. What this is, it's a sign that costs are rising faster than revenues and companies are being forced to cut as demand plunges. And this is why nobody wants to hire. Because last month, employers announced 5,306 hiring plans. That's the lowest total for a month since Challenger began tracking hiring plans in 2009. And we all remember what happened in January 2009. We were at the depths of the global financial crisis. Now we're on the cusp of one, and I've got the charts to prove it, plus the one I'm following every day, and you've got to see this. Now, let's dive in deeper because I want you to see when the labor market goes, the stock market and the economy are soon to follow. Because initial claims, they're up. Initial claims increased by 22,000 to 231,000. But get this, unadjusted claims, which normally should be dropping this time of year, jumped 20,000 to over 251,000. And on top of that, continued claims are higher too. Continuing claims, which are a proxy for the number of people receiving benefits, increased to 1.84 million in the previous week. Unadjusted continued claims, they surged by over 77,000 to 2.21 million. And what that is a sign that there's no work out there for those who lose their jobs. Now, before I show you the relationship between markets and claims, I need you to see this. Because where continued claims go, initial claims are going to follow. And here's the proof in this chart of continued claims in blue versus initial claims in red. And what I want you to see is that initial claims are likely to rise in the months to come since there aren't enough new jobs being created. And if this pushes continued claims higher, which so far it looks like is going to happen, you can see it means we're headed right into a recession. And following that, there's going to be a market crash. Now, let's take a look at this next chart of continued claims in blue versus the Nasdaq 100 in red, because I want you to see going back to 1990, 2000, and 2007 is that as claims started to rise, what would happen? The stock market would eventually come crashing down, and that's what we're facing right now. Because based on yesterday's ADP payroll report, it's very clear since April of last year that the economy hasn't been creating enough new jobs. Meaning, those 108,000 that are about to get pink slipped, they're going to have little opportunity to re-enter the workforce. Now stay with me, because those weren't the only labor market indicators we got today that are saying the market's about to crash. Because job openings, they're disappearing fast. Available positions decreased to 6.54 million from a downwardly revised 6.93 million reading November, according to the Bureau of Labor Statistics. Meaning, with every passing month, there are fewer and fewer jobs out there for those who are on long-term unemployment and those who are about to lose their job. Now, I need you to understand what this means for those who do have a job, and I'm going to tie this all back to the stock market. Because what's coming next is hours are about to get cut. And when employers cut job openings, they also cut hours. And here's the proof in this next chart of the JOLT survey in blue versus average weekly hours of production and non-supervisory employees in red. And I want you to see that going back to 2001, 2008, and 2019, the declines in job openings are soon followed by a cut in hours. And this is what's coming for workers in the next couple of months. Now, stay locked in because I want you to see these next charts on how they indicate we're on the cusp of a major market crash. Because job openings, they lead stocks. And here's the proof in this next chart of the JOLT survey, still in blue versus the Nasdaq 100 in red. And first, I want you to see the tight relationship between these two going into the dot-com bubble and the global financial crisis. And with no surprise, in 2022, as job openings fell, stocks went down until everyone started buying the correction, which was boosted by the yen carry trade, President Trump's win, and AI mania. But the problem right now is job openings have continued to decline, as you can see, and the stock market at this point needs to catch down to it. But hold on, I know you're thinking, well, Steve, this is just probably a new normal because stocks can only go up. But hang tight, because if people have fewer hours, that means there's less money to buy stocks. And here's the proof in this next chart of average weekly hours of production and non-supervisory employees in blue, still overlaid against the Nasdaq 100 in red. And you can see again the tight relationship between the two, except for starting right around 2023. And what I want you to understand is that fewer jobs and fewer hours, with inflation still rising, it leads to less consumption. And as demand falls, it means profit and stocks are likely to come crashing down, which is exactly what the Treasury market was warning about that I covered in yesterday's show. Now, let's talk about the one chart I'm looking at every day that validates that the crash indeed is imminent. Because the big players, they've been cashing in when I tell you to keep buying.